Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Sanchez, Balcazar, Head of Global Bonds at Pictet Asset Management, to discuss where the anxiety about inflation is coming from and diversifiers for your portfolio against inflation scare scenarios. Andres, it's great to meet with you. Welcome to Trade Talks.
Thanks, Jill. Great to meet you as well. Well, when we talk about anxiety on inflation, I think the main source of that anxiety is really coming from the incredible amount of stimulus packages that we've seen around the world, in particular on the fiscal side. And in many cases, and this pertains exactly to US, the size of these packages is judged by many analysts as being too large for what is needed. And so that has generated a bit of this notion of excess demand in the economy. This year, for example, the fiscal stimulus in the US is going to be between 10 and 12% of GDP. And the pandemic marked then the end of the fiscal austerity that we had seen for the last 40 years. It's something that we are not accustomed to see this kind of fiscal spending. And so people think that this might generate inflation.
How will it impact economic growth, though?
Well, traditionally, the interesting thing is historically fiscal spending has actually generated very strong short-term impacts on growth, but actually longer term, the impact on growth from fiscal spending is actually pretty small. So a lot of people are betting on fiscal spending this time being more impactful, probably have a higher multiplier or have bigger productivity gains, but that remains to be seen. And actually, we would be quite skeptical that fiscal spending can have a permanent effect on growth in the longer run.
So with that backdrop, what kind of approach is Pictet taking when looking at inflation?
Well, when we look at inflation, rather than trying to predict exactly how much inflation are we going to have, in particular, we're heading into a period where volatility of the inflation numbers is going to be huge because of the big base effects from last year's. We'd rather work on scenarios. So at the moment, we see three main scenarios for inflation. We see the first one is that once we have these base effects gone through and a small inflation overshoot because of these base effects, we would get the same amount of inflation growth per month that we used to get over the last 5 years. And that I would call this kind of same old inflation environment. And in that case, it would be very hard for the Fed to achieve its Fed target because inflation would tend to undershoot the target again. The second scenario is what is currently priced by markets, which is what the Fed expects, which is an overshoot of inflation over the next few months to around 2.5%. And then over the medium term, inflation returning just above the target. So on average, inflation is going to be at around 2%. And it's amazing that the market has given so much credibility to that Fed scenario. But right now, that's what we have priced in markets. And finally, the scenario that a lot of people fear right now is that inflation overshoots by more than what the Fed is actually expecting to be and by more than what markets are actually pricing. So inflation going on a more permanent basis over 3%. And we believe that in that scenario, the Fed would be very quick to slam on the brakes because they risk de-anchoring inflation expectations, which is something that central banks have achieved over the course of the last 40, 50 years. And so that is very dangerous for a central bank because it plays against its credibility. And that's why we think if that scenario materializes, we could have, difficult markets, first of all, but the Fed's slamming on the brakes.
What could be good diversifiers against inflation scare scenarios?
Well, Traditionally, people say commodities, and there are definitely some commodity currencies that we would argue are still underpriced relative to the movements in commodities, like, for example, the Australian dollar or the Canadian dollar, or actually some of the emerging currencies like the South African rand or the Colombian peso or the Mexican peso, for that matter. But also, we believe that a great diversifier for an inflationary scenario in the Western world would be to own some Chinese renminbi bonds. And why Chinese renminbi bonds? Because China has been trying to position itself as an alternative reserve currency for the US dollar. And to achieve that, China needs to transmit this idea of a currency that is stable and that is a good reserve of value over the longer run. So we believe, interestingly enough, that China has a huge incentive not to monetize, not to expand spending as much as we do in the West. And in that scenario, then, Chinese renminbi bonds would do much better than bonds in Europe or in the US.
And to wrap up here, sticking with the global bond theme, whatever happens to inflation, what do you believe will happen with global bond markets?
Well, at the moment, as we mentioned before, global bond markets are pricing this Fed scenario, so are giving a lot of credibility to what the Fed is saying it will happen. So on top of that, when we look at how investors are treating their bond portions of their portfolios, we notice that a lot of them are actually short bonds in their portfolios. Many levered investors are, for example, shorting bonds to protect their equity positions, which for us probably makes us think that it's a good idea to own some bonds in your portfolio, in particular in the very long end of the treasury curve, which is pricing you already a lot of inflation expectations over the longer run, and so offers value in the case those inflation expectations don't materialize, or in the case we have further sell-offs in risk markets like equities or high-yield bonds.
All right, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks very much, Jill.